In this video, we are actually going to learn something that I was taught when I took my intro to accounting classes. And I was taught this at Brigham Young University by the Stice brothers. They call this the Jim Stice method of creating a cash flow statement. And I particularly like it because what it does is it organizes the creation of both an indirect and direct cash flow statement pretty simply. And it enables you to look and think about things in kind of a structured way. So that's where I got this, and we're going to go through it right here. And it's really important to keep things organized. And the reason why you want to keep it organized is because it gets pretty complex creating this cash flow statement. So what we do is we have our traditional income statement right here. We have our income statement where we have our sales, cost of goods sold, and depreciation, and then our net income. And we have a few balance sheet accounts here: accounts receivable, accounts payable, and inventory. And what we want to do is we'll say, okay, we're going to create this matrix right here, the income statement, and then we're going to have adjustments next to it, and then operating cash flow. And what you do is by having this income statement and then having the adjustments, we are going to create an indirect cash flow statement in this column. And then in this one, we're going to create a direct method of operating cash flow. So both of these we're just creating operating cash flows here. And the indirect method, as you recall, starts with net income and squeezes out all the accruals. This is how most people do a cash flow statement. This is how most financial statements use. They use an indirect method for reporting these things. So let's get started. So the next step is to take the balance sheet and then find the net balance difference between the beginning and ending period. And what I want you to do here is I want you to actually just do arrows with each one. So we'll see accounts receivable went down. It went from 500,000 to 300,000. So I put a downward arrow. It went down 200,000. Now, the reason why I do an arrow instead of a plus or minus is because it's really important for you to know in your mind what happened to the account. It went down and what that means to cash flow, because it's not obvious. And even when you know the accounts, it's hard to remember it sometimes because you're like, okay, inventory goes up, down, what happened to cash? We went through the other examples proofing this to show you how this net account works, but you still have to think about it. So your brain's going to need to be on for this. So the accounts receivable, the netting, the math of the netting is no big deal. Anybody can net these accounts. It's super easy. I mean, we were doing subtraction type of stuff. We were doing that in elementary school, right? But knowing the cash flow, knowing what's happened to your cash, that's what's hard. That's what's hard with this. So don't think, oh, I know the net, so I've done part of the problem. No, the hard part is knowing what's going on with the cash and getting the signs right. So accounts receivable goes down 200,000. Accounts payable goes up 300,000, and our inventory goes up 200,000. And that's the net between the beginning and ending amounts. So accounts receivable down, accounts payable up, and inventory up. Well, what does that mean for our cash flow statement? Well, we take the accounts receivable, and accounts receivable is tied to sales. So we're going to put that accounts receivable going down amount in our adjustment. And our accounts receivable going down is going to be a 200,000 without brackets on it, because we're going to add that to the net sales. What does that mean? Well, in a prior video, we went through the example to show that accounts receivable going down means that more people have paid us back than we've built new credit accounts with. You think about credit accounts that we get from this year on sales and credit accounts that we had from the past. Well, let's assume all those sales were on credit. All 8 million were on credit. Well, guess what? Even with 8 million on credit, accounts receivable still went down 200,000. That means that we collected $8.2 million in our sales from customers. So all we have to do is say, okay, accounts receivable went down. It went down. That means we have more cash. We're going to add that 200,000 to 8 million to get to the operating cash flow, our operating cash flow column. So that's our net adjustment for sales. Cost of goods sold, as you recall, has two accounts: inventory and accounts payable. Our accounts payable went up 300,000 and our inventory went up. But here's the thing. Accounts payable going up and inventory going up doesn't mean the same thing for cash. Accounts payable going up means that our cash actually also went up because we got things without paying for it and potentially sold them as part of our inventory. So accounts payable going up 300,000 is a positive for positive cash flow. It increases our cash because we got inventory on account and we didn't have to pay cash for it. Inventory, however, going up, we don't know what the mix of accounts payable cash is, but inventory going up requires some resource. So inventory is a downward pressure on cash. So we're going to put brackets on it. So our cash goes down as inventory goes up. Now, some of you might be saying, wait a second, why two accounts? Why accounts payable? I go through a proof in a prior video. It shows you just how this works, how the two of these work. Because you buy some on cash, you buy some on account, and you pay some off. So you need a little bit of both because the cost of goods sold is an inventory number. So you need to use accounts payable and inventory. Well, if you use accounts payable and inventory and you get your signs right by having 300,000 added as a cash increase and 200,000 as a cash decrease, then you would put those two right there, and those are your adjustments in your indirect method. And then your depreciation, you're going to add back your depreciation. Depreciation is not a source of cash flow. However, in this net income number of 1.5 million at the bottom, guess how we got there? 500,000 subtracted to the balance between sales and cost of goods sold. So that net income number includes the amount of depreciation that's there. So what we're really doing is we're adding back depreciation. We're adding back depreciation. And so those are the net adjustments you would need to put in for the operating cash flow on the indirect method. Well, what we do then to get the direct method is we look at this matrix and we say, okay, 8 million plus 200,000 is 8.2 million. Cost of goods sold less the 6. So cost of goods sold is 6 million. We got a positive cash flow of 300,000 because we got some of that inventory on account. And then we also bought the inventory of 200,000. We've got 300,000 increase in cash because we have more accounts outstanding that we didn't pay cash for. And our inventory increased, and accounts payable and inventory are going to be tied to cost of goods sold. So accounts payable and inventory, you'll notice they both go up, but accounts payable has a positive cash flow effect, and inventory increasing has a negative cash flow effect. So the net between those two is used against the 600,000, and we end up with 5.9 million because the 300,000 net the two, and 6 million is a negative cash flow number on the cost of goods sold. We have to net out the accruals there. We get to 5.9 when we go across the board there, across the matrix of cash payments to suppliers. Then depreciation. Well, 500,000 net 500,000 is 0. So what's our operating cash flow? 2.3 million. 2.3 million is our operating cash flow. And you'll notice each column is the indirect and the direct method. And if you actually go through and use that net income and put that net income up at the top of the adjustments and go all the way down and do the math all the way down through those adjustments, you have net income at the top and you have your cash flow from operating activities at the bottom of that second column in. And that's your indirect method. So you have your direct and indirect all in one spot. And this is the cash flow matrix for solving, how to get to a cash flow statement of operating activities using the indirect or direct method. It's the matrix. It's a simple way of doing stuff, and I'm a fan of it.